There is this country. It had big, mighty, and powerful friends across the world. It had a romantic relationship with the Wall Street, worth trillions of dollars. But then this country had a painful breakup with Wall Street. It pulled out some big companies from the New York Stock Exchange. That was a sign to the Wall Street. I'm dumping you. I do not need you, and I'm over you. But this country has been in an economic mess for a long time now. It has inflated its economic and fiscal numbers. It has arrogantly claimed to be the world's second largest economy. But its economy has been resting on a foundation of lies. And when it snapped ties with the Wall Street decided to hit back. JP Morgan Chase is leading the fight against this country, and one statement by the Wall Street giant has led a major real estate developer of the country to run into the ground. Do we even need to mention that the country in question here is China? I didn't think so either. Hi and welcome. You're watching TFI Global, the foreign affairs and geopolitical analysis arm of the TFI Media Group. I am Atul Mishra, your host. In this video, I will talk about how China's shrewd cooking the book move led to the fall of yet another real estate giant. Let's begin. You own a company with a market capitalization of say $1 billion, but you're not being able to exude much investor confidence. Your company is somehow failing to rope in investors, and your market cap as a consequence has been stagnant for a long time. What do you do to lure investors to put their money in your company? There are two ways, the shortcut and the long cut. One is legal and the other one is illegal. The legal mechanism of attracting investors would be to overhaul your company completely, bring in drastic changes, give them incentives, and make your company significantly secure and fiscally stable. The illegal way to attract investors is to cook your books. What does cooking the books mean? Cooking the books is a term for using accounting tricks to make a company's financial results look better than they really are. Cooking the book refers to the shady process of comprehensively manipulating financial data to inflate a company's revenue and deflate its expenses in order to pump up its earnings or profit. With earnings getting artificially inflated on paper, investors will rush to invest in your company, but they will be investing in a balloon, and sooner or later your company will come crashing down. China has been manipulating its economic and financial data for years now. Its criminality is finally beginning to catch up with it. The Chinese Communist Party suddenly finds itself clouded by a number of crises, whether it be the imminent collapse of China's real estate sector, complemented with a massive financial crisis, or the country's energy crisis, which refuses to abate. Investors are fleeing China as they realize that they have been putting their money in a deep and dark well from where it can no longer be recovered. So investors have actually been putting their money in companies which they have no idea are debt-laden. In China especially, investors are not allowed to ask many questions. So if the company they have been investing in has been cooking its books, there is no short way of them knowing it before the crisis really comes staring them in the face. This is what has happened with several of China's real estate companies and their investors. With the wall of bond maturities coming due in January, China stares at a 2008-like financial crisis of its own. A series of Chinese real estate giants have been tumbling like a house of cards. Considered among the sector's strongest players, shares of Shimao Group Holdings and its property services units were among the biggest losers in Hong Kong trading on Tuesday. Shimao Group Holdings dollar notes dropped as much as 12 cents on the dollar. The downturn came after the deal between two units of Shimao Group Holdings heightened corporate governance concerns. According to JP Morgan Chase analysts, a connected party acquisition announced by the developer late Monday not only implies tight liquidity conditions for Shimao, but is also a corporate governance red flag. The Monday announcement that Shimao's services unit had agreed to buy another unit of Shimao Group for 1.65 billion yuan or $259 million was taken as a sign by some analysts that the developer is shifting cash from stronger to weaker parts of the business. Shimao Group's shares fell as much as 18% in Hong Kong on Tuesday, heading for a record tumble, while Shimao Services holdings plunged 33%, while Shimao Group's 4.75% bond, whose maturity is dated 2022, dropped 8.7 cents to 71 cents, leading declines among Chinese high-yield debt. Now, as Shimao Group joins a long list of Chinese real estate developers nearing default, investors will begin decoupling from China en masse. JP Morgan Chase has raised red flags against the Chinese company, and it is only a matter of time before other Wall Street giants and credit agencies begin doing the same. TFI had recently explained how the romantic relationship between China and Wall Street has come to an abrupt end. Now, China's fortunes are about to take a big hit as it finds itself in an extreme dearth of investors.